For decades, dividend investing has been seen as one of the safest and smartest ways to build wealth and generate passive income. The strategy is simple: buy quality companies that pay you a share of their profits regularly, reinvest those dividends, and watch your wealth grow over time. But in 2025, things look a little different. Interest rates have shifted, inflation has been a roller coaster, tech stocks are dominating, and investors are asking the big question: is dividend investing dead? In this video, we'll break it all down: what dividend investing really means in 2025, how the investing landscape has changed, the pros and cons of dividend stocks today, whether dividend investing still makes sense, or if you should look elsewhere, and a practical roadmap for building wealth with or without dividends. Welcome to Smart Dollar Mindset, the channel where we teach you how to achieve financial freedom through smart money habits and investing strategies that actually work. If you're serious about building wealth and taking control of your financial future, hit that subscribe button and let's dive in. What is dividend investing? A quick refresher before we talk about whether dividend investing is dead, let's define it. Dividend investing is a strategy where you buy stocks from companies that pay a portion of their profits back to shareholders as cash payments, called dividends. For example, company XYZ earns $1 billion in profit. It decides to return 40% of that profit to shareholders. If you own shares, you get your cut, usually paid quarterly. Investors love dividends because they provide predictable income, especially in retirement. Reinvestment opportunities: buying more shares accelerates compounding. Stability: dividend-paying companies tend to be well established. Historically, dividend investing has been a powerful wealth-building tool. But does it still work in today's economy? The rise and fall of dividend investing popularity. Dividend investing became hugely popular because it offered steady returns. It was less risky than chasing growth stocks. It worked beautifully in low interest rate environments. But then came the 2020s. Tech companies exploded in value, most of them paid little or no dividends. Inflation surged, cutting into real returns. Interest rates climbed, making bonds and savings accounts more attractive. Now, in 2025, many investors are wondering, is it better to chase growth stocks? Do dividends still matter when AI-driven companies dominate headlines? Are there better ways to create passive income? What's changed in 2025? Let's break down the key shifts. 1. Higher interest rates. For years, interest rates were near zero, making dividend stocks attractive for income. Today, with savings accounts and CDs paying 4 to 5%, some investors ask, why take stock market risk for the same yield? 2. Market volatility. Dividend stocks, once considered safe, have faced price swings too. Many companies cut or suspended dividends during tough times. The pandemic proved that nothing is guaranteed. 3. Growth versus income. Tech giants like Tesla, Amazon, and Google rarely pay dividends, but their stock price growth has crushed most dividend stocks over the past decade. Investors are tempted to prioritize growth over income. 4. Inflation pressure. If your dividend stock pays 3% but inflation is 4%, you're technically losing purchasing power. That changes how investors think about income strategies. Is dividend investing still worth it? The short answer: yes, but with adjustments. Here's why dividend investing is not dead. Dividends are real cash. Unlike paper gains, dividends are money in your account. Compounding works. Reinvested dividends can double your wealth over decades. Market cycles favor income. Growth stocks can underperform in certain markets, while dividend stocks keep paying. But here's the catch. You can't just buy any high dividend stock. You need quality and sustainability. The pros of dividend investing in 2025: passive income, great for retirees or anyone wanting steady cash flow. Lower volatility. Dividend-paying companies tend to be more stable. Psychological comfort. Getting paid during downturns makes it easier to stay invested. The cons of dividend investing in 2025: lower total returns. Many dividend stocks underperform growth stocks over long periods. Dividend cuts. Companies can slash payouts when profits fall. Tax implications. Dividends may be taxed differently depending on where you live. Types of dividend stocks. Not all dividends are equal. Here are the main categories. 1. Dividend aristocrats. Companies that have increased dividends for 25 plus years. Examples: Coca-Cola, Johnson & Johnson. 2. High yield stocks pay large dividends, often 5% plus. But beware, high yield can signal financial trouble. 3. Dividend growth stocks pay modest dividends today but increase payouts consistently. The power of reinvestment. Here's why dividend investing still shines. Reinvestment. Example. Invest $10,000 in a stock yielding 4%. Reinvest dividends for 30 years at 8% annual growth. Final amount, over $100,000, without adding new money. Dividends accelerate compounding. Should you focus only on dividends? No. A balanced approach wins. Combine dividend-paying stocks with growth stocks. Add bonds and ETFs for stability. Diversify across sectors and geographies. The best dividend strategy in 2025. Here's a practical game plan. Focus on quality, companies with strong balance sheets and consistent dividend history. Look for dividend growth, avoid companies with unsustainable high yields. Use ETFs, dividend-focused ETFs like SCHD or VIG provide diversification. Reinvest automatically. Most brokers allow automatic dividend reinvestment. Combine with growth, don't ignore tech and innovation stocks. How much should you invest in dividends? Depends on your goals. Young investors, 20 to 40% in dividend stocks or ETFs, rest in growth. Near retirement, 50 to 70% in dividend stocks for income stability. Real life example. Imagine you invest $500 per month into a dividend ETF like SCHD, yield, 3%, annual return, 8%, including growth after 30 years, $750,000 plus annual dividend income, $22,000 plus without selling a single share. That's financial freedom. Alternatives to dividend investing for passive income: bonds and treasuries, safer but lower returns. Real estate, rights, income plus potential appreciation. Covered call ETFs, higher yields but with risk. Is dividend investing dead? The final verdict: no. Dividend investing is not dead, it's evolving. In 2025, it's still a powerful tool for generating income, providing stability, building wealth over time. But you need to be selective and flexible. Combine dividends with growth and other income strategies for the best results. Your action plan for 2025: assess your goals, income versus growth. Choose a diversified mix of dividend and growth investments. Reinvest dividends for maximum compounding. Stay consistent, ignore the noise. Final thoughts. Dividend investing isn't about hype, it's about steady, long-term wealth. If you want financial freedom, focus on strategies that work across market cycles. And remember, wealth is built by staying invested, not by chasing the next big thing. If you found this video helpful, share it with someone who wants to invest smarter. And don't forget to subscribe to Smart Dollar Mindset for more tips on money, investing, and building wealth the right way. Financial freedom isn't luck, it's a plan. And your plan starts today.